Our first stock is Philip Morris, a cigarette company. So what's the market cap for this company?
Guys, let's call it $130 billion. PE ratio, 16.76. So check mark there. We want it below 20.
Okay, how's the profit margin going?
Look at this profit margin. Jesus Christ. 30%.
Wow.
Check mark there. Looks like Jesus loves his cigarettes.
What is... You mean Jesus.
Jesus loves his cigarettes.
Revenue growth, pillar number 3.
Well,
Paul.
wait a second. We have a thing called a dividend here,
how's the dividend?
6% on 130 billion. What is that? Yep. $780 million? Yep. Did I do the math right? Somebody please tell me I did the math right.
Spicer, figure it out.
$780 million. So guys, we want to look at the free cash flow and make sure it's supported there. So
pillar number 3 is revenue growth over the past 5 years.
So $74 billion here and 77.9. But keep in mind, guys, look back here. They cleared 80 a couple times. This is a big drop here in 14 and 15. So I'm wondering if, not that it matters, but I'm wondering if there was a sale of something at that point. But either way, they do have 74 and $78 billion. It's a check mark.
Okay, profit growth is pillar number 4. You'd think I know these by now, but I don't. Keep going.
You do know them. 6.9 versus 7.2. Check mark there. Very steady, very steady. Very steady. Steady Eddie.
A tattoo shop. Pillar number 5 is shares outstanding.
I'm actually surprised
we want this
by
going
this.
down. What's up?
It's actually an X, slightly up. Not by much, but that's slightly up. I'm actually surprised. I thought there was going to be massive, because I look at a company like Philip Morris, and in order to, you think that, okay, we're in cigarettes, probably not a growing market, so how do we give more back to our investors? We buy back shares. So I don't know. I was actually surprised. I thought it'd be significantly lower.
So it's an X for shares outstanding. They're selling more. Let's do current assets over current liabilities is pillar number 6, baby.
17.45 versus.
Come on.
15.52. That's a check mark.
Is
that my phone?
That is 5 checks and an X. Free cash flow growth is the granddaddy of them all. Free cash flow growth, Paul.
Free cash flow growth. Okay. So guys, look at this. Huge free cash flow. And here's what I like about it. Their capital expenditures are not a big chunk of their free cash flow. Even in their worst year, it's not even 15%. I mean, maybe it's 18%, so it's very low. So let's call it let's call it 6.9 versus 9.2. Check mark.
Okay.
And then 6.9, and then 7.4, and then 8.
Nice growth, huh?
Yeah, it's very consistent. I like it.
The average is 7.7. My apologies. 7.7 is their average free cash flow per year.
Okay, so now, guys, we have to talk about what multiple we're going to apply to it. Mm-hmm. Now, the positive of this company is even with a declining market, they're still able to increase their free cash flow pretty consistently over time. Low capital expenditures, I like that. Obviously, Philip Morris is a well-known, but like what brands they have under their umbrella? I mean, it's a ton of brands, right?
Well, you said that we were talking about Philip Morris and Altria, and you said, aren't they the same? And A. Bitler saying that maybe they want to merge. That Altria, which we're looking to do next, and Philip Morris want to merge.
Is that being talked about, or is that speculation?
Maybe so.
I don't know if the government would allow that.
Say that again, Mo, one more time.
I don't know if the government would allow that. That would bring monopolies into the question.
They said that about Sirius and XM. That was a huge concern back in the day with that radio, but we'll see.
Mm-hmm.
Okay.
All right, so
what is your multiple for price to free cash flow, Paul?
Let's say it's times 20. That is 154.
Yep, 154.
What's the market cap?
130 billion.
Oh. All right, so if you believe 20 times multiple is a good multiple for this, you're at a check mark here. Go do more research. Figure out if you want to buy this. Check, please. The only thing I have a problem with is this.
Go on.
Their average, now granted it's the average. Last year they did 9.2 billion. They spent 7.3 billion on dividends. So they're paying out a lot of their profit to dividends. Let's see how they did in the last 12 months, COVID time. Oh wow, $9.3 billion in free cash flow.
That's much higher than their average of 7.7.
Yeah, so, I mean.
You're liking cigarettes now.
I mean, hey, send me to school with a bunch of cigarette packets. I'll just start handing them out to kids.
Great plan.
Is that crickets?
I missed the crickets. I'm a little late on that.
I mean, I'm not opposed to this one. Mo, what's your thought from a financial standpoint?
Yeah, let's go to Mo for Mo money, more problems, momentum.
Let me read this to you. On January 2003, Philip Morris Companies changed its name to Altria Group. Even under this new name, Altria continues to own 100% of Philip Morris.
Oh.
Oh, wait a
I
minute.
thought they were the same company.
Paul, you were
Yeah.
right. You were right. They are one company.
So let's do the fundamental or the technicals for this. So the first thing that I noticed when I zoomed out on this chart is about $93 dating back to March of 19 is they kind of can't break that resistance point, and they're kind of getting up there with this 82.92 number. So that's going to be very heavy resistance for them to get through. Now let's zoom into right now.
And if they get through it,
if they get through it, they can go. That absolutely. It's just a matter of can they generate that kind of volume, do something, new product, something that can really boost them up. Right now, though, they're having a great day today. They're up about 3.5%, but their overall trend is going right down in the sweet spot. So if this is me and I'm playing this, I'm not touching this right now. I'm just going to let it sit and figure out what happens. If I do get a day like this tomorrow with a big candlestick, a big red candlestick in the down direction, then I'm starting to think about some kind of short on it. So that's the momentum for this one.
If anyone owns this stock, put in the comments if you own some of it and how much you have and maybe
I
why
have
you bought
puts
it.
on it.
Yeah, Paul, you're saying you have puts?
I think so. I have it. Maybe I have it on MO.
You have it on Altria.
Altria.
MO, yeah.
Yeah, people are talking about British tobacco, which we've analyzed in the past.
So should we look at some options for Philip Morris?
Yeah, please do.
All right, guys. So since it's kind of maybe in the money here, maybe. Oh, hello. How you doing, kids?
Make sure you guys are tickling that thumbs up. We love you out there. Paul,
So remember what we do with options. Selling puts is a way to get a position on a company and being paid to wait. So as an example, Philip Morris is currently at 83. Let's say you're like, okay, I like it, but I'm not in love at 83. I want to buy it at 70. March 19th, 2021, that is 44 days from now, you can sell a put and get 47 cents. So what that means is you're going to be paid 47 cents to wait. What's your return? On a put, it's the premium divided by the strike price. What's 0.47 divided by 70?
Sorry.
I'll do this right now myself.
I got it, Paul. 0.47 divided by 70 is 0.0067.
Divide that by 45.
Divided by 45 is 0.00014.
Multiply by 365.
Times 365 is 0.054.
So 5.4% return, annualized return.
Wow, look at that.
You're going to be paid a 5.4% annualized return to wait, which means if you did this over and over, 44 or 45 days out, over and over, and got 47 cents, you'd make 5.4% return on your money. That is what I do with options. That's what I do with puts. I pick price in the future. Now, I can go out further. Let's say I really believe this company is going to be stable for a long time. I might go to January 2022. The further out you go, the more money you'll be paid because it's more likely that things hit. So the same $70 put here, you're now getting $4.58 per share, but you got to wait 352 days for it.
And there's a 27.5% chance of that occurring.
The delta is 0.275, which means there's a 27.5% chance that you will be assigned these shares at some price below 70. So these are the things we do. I don't believe in going long-term unless it's a very, very volatile stock that's been hit hard. We did it on Carnival Cruise Line and Love, Southwest Airlines, because the volatility was so high that basically if you thought it was going to stay in business, we were making 20% annualized return on money just by waiting. If I just thought it was staying in business, I was going to make money.